Hi everyone, thank you for joining us today. I'm just going to do a quick introduction of today's information session, and then I'm going to introduce our expert guest as well. So obviously it's end of financial year, happy EFS to everybody, and some of our clients have specific questions relating to their investment property, buying and selling at this time. So we thought it would be a very relevant topic to hold a webinar on. As to obviously why you're all here. So I'll kick it off by introducing our expert guest speaker, who is Chanel Palmer. So Chanel's a manager at the National Tax team at Pitcher Partners. So Chanel's joining us now. As a part of her role in National Tax, Chanel is heavily involved in consultation with the ATO and Treasury on various legislative and interpretive matters. So she's very experienced and very knowledgeable. She has over 8 years' experience in taxation, providing advice on a broad range of income tax issues affecting both private and corporate clients. Chanel commenced her career as a graduate in the Australian Taxation Office, most recently working on issues of tax policy across Treasury and also the ATO. So thank you for joining us, Chanel.
Thanks for having me.
So basically, Chanel is going to share her screen as she has a PowerPoint presentation, and we've got a few questions we have prepared, which Chanel is going to provide some answers to. So Chanel, if you're happy to share your PowerPoint. Thank you.
There we go.
So one of the first questions we have here is, how is income from a rental property taxed?
Yeah, investors are generally taxed on receipt of their rental income. So for a typical income year, all you'd have to do is add up all the rent that you've received, so between the 1st of July and the 30th of June, and include that in your income tax for tax purposes.
Yeah, lovely. And what expenses can be claimed as a deduction?
So you can claim certain expenses. Include interest, advertising, owners corporation fees, so your body corporate fees, and then things like council rate and water charges, land tax, and agent fees if you've got a real estate agent that's managing the property as well. And importantly, the cost of tax returns and advice from registered tax agents is also deductible.
Okay, lovely. And repairs and maintenance for rental properties, because there's general maintenance such as sending out a plumber to fix a leaking tap, and then I believe there's a difference when it comes tax time between general maintenance and improvements. Say, if an owner decided to install a split system in their rental property and there wasn't one previously. So can you just talk to us about repairs and maintenance and how that's factored in?
Yeah. Maintenance is cost incurred to repair normal wear and tear and deterioration. Appliances, even repainting painted walls between tenants. However, if the costs go beyond repairs and amount to what's called an improvement, then this is generally a capital cost, which is not deductible immediately. So an example is if you remodel the entire kitchen or you replace an appliance during the year. So the other thing to note is that your initial repairs are viewed as capital. So this is when there's an existing damage when you buy the property and you need to bring it up to the standard for your tenants. Those will also be capital as well, so they won't be repairs and maintenance costs.
Lovely, thank you. And how are the capital costs and depreciation claimed?
So certain capital costs are not deductible immediately, so in the year that you incur them, but they are deductible over the lifespan of the asset that you've purchased. So, for example, things like the cost of carpets, curtains, bathroom and kitchen appliances, air conditioners as well, particularly important in Australia. These can be written off on a straight line, so a uniform cost over the life of the asset or how long you can generally use that kind of asset, or a diminishing value basis, which is effectively where you assume that the asset loses its value faster over the earlier life of the asset. And this could be anywhere from, say, 2 years to 20 years, depending on what you're looking at. Some capital costs relating to construction costs or capital improvements are generally considered what's known as capital works rather than depreciation. And they're deducted over an equal basis over 40 years, so at 2.5% each year. So examples of that include things like the cost of constructing walls, doors, built-in kitchens, and bedroom shelves and things. And these can include costs that are incurred by the developer or the previous owner, and the investor can then just take over the capital works deductions for the remainder of the 40-year lifespan of the building.
Okay, lovely. Now, for some clients that may not be aware of it, there's such thing as a tax depreciation schedule, which is recommended. So can you tell us a bit about that and how it can help when it comes to property?
Yeah, of course. So there's often a lot of confusion about whether capital costs relate to depreciating assets, as we've said, or capital works, which are written off over 40 years. It can also be really difficult to work out the correct lifespan of a depreciating asset. So the tax office does provide a list. It's hundreds of assets long. So working out which asset you're looking at and what the lifespan is can be really challenging for individual investors. As well, if you buy a new investment property, we won't actually know how much was spent on each of those depreciating assets or how much the cost of construction was when you buy it. So a tax depreciation schedule can be prepared by a quantity surveyor, and it essentially sets out the claims that can be made for your property for future years, and the tax office will generally accept this. So you can just take column A, column B, pop it into your tax return, really easy. And then the cost of this report, which can be anywhere between sort of $500 to $1,000, is also tax deductible for you in the year that you purchase it as well. Any new capital expenses you incur after you've obviously purchased the schedule will need to be considered as they are incurred, though.
Yeah, no worries at all. And are there any concessions that provide faster tax depreciation?
So as we mentioned before, there is a difference between the way you can calculate your depreciation. So choosing a diminishing value method, which, as I said, assumes the value of the asset decreases more in the earlier years, can provide a higher depreciation cost in those early years. So, for example, if you have an asset that's generally seen to have a lifespan of about 5 years, the straight line method allows a uniform deduction of 20% per year. On the other hand, diminishing value method would allow you to write off 40% in the first year and then smaller amounts in each subsequent year. In addition, some low-cost assets can actually be deducted quicker. So if your asset costs less than $300, you can write that off immediately. If it's between $300 and $1,000, you can pull that with other assets of the same sort of similar values and group them together and deduct them as a single rate, which can also be convenient and provide less calculations for you. So with that, you deduct it at 18.75% in the first year, and then you get a standard 37.5% of the value of the pool each year. There are various other concessions like the instant asset write-off and such for capital purchases, but these generally do apply to businesses rather than passive investors.
Okay, lovely. And what type of costs can't be deducted?
So there's a few things that you should be aware of as an investor that you can't claim against your rental income. The most obvious one is that you can't claim for costs that you didn't pay for. So we mentioned the example of water rates. If the tenant's paying the usage fees and you're paying the service charges, you can only claim a deduction for the service charges that you're paying. So likewise for electricity or other utility fees that are paid by the tenant. You also can't claim any costs where the property is not used to generate rent or not available for rent in that period. So for example, if you've got a family member that's using the property at that time and you're not advertising it, if the family member is paying you some in line with that, the difference between market value. Some recent rules have also restricted some of the other costs that can be claimed for investment properties. So the big ones are travel costs relating to the property. So you used to be able to deduct the cost of traveling to inspect the property and maintain it, and also collect rent as well if you're doing it in cash. You now no longer can claim those travel costs. The other one as well is holding costs such as interest rates and land tax can't be deducted while the property is undergoing substantial renovations, or importantly, when the land is actually vacant. The other one to note is since the 1st of July 2017, you can't claim depreciation for second-hand assets. So that does include where you buy an investment property from the previous owner, or where you used it for private purposes and then you decided to rent it out. However, you can still get the deduction for capital works that we mentioned earlier over the 40-year lifespan of the building.
Lovely. And can you explain negative gearing for us?
Yeah, certainly. So negative gearing is where a property investor makes an annual loss for the investment. So generally where the deductions for the year are more than the income that is received. This is more common in the first years of your investment where the depreciation claims can be large and the interest is often greater before the loan balance starts subsequently reducing with your repayments. Generally, investors are able to use that rental loss to reduce their tax on other Australian taxable income. So if you've got salary from employment or from other investments, you can use that loss to offset that. However, if you don't have other taxable income, then that negative gearing strategy won't be as helpful to you, as the loss on the rental property is essentially just carried forward to be deducted in a later year.
Okay, lovely. Now, if I'm an overseas client, okay, not an Australian resident, and I own a property here in Australia, what tax rates apply to me? What tax do I have to pay?
So we've included the tax rates on the current slide in front of you. As you can see, for an individual that isn't an Australian resident, the first $90,000 is taxed at 32.5%. After that, each dollar until $180,000 is taxed at 37%, and from there, each dollar above $180,000 is taxed at 45%. I would note that these rates are scheduled to be reduced over the coming years. I believe from the 1st of July 2024, a 30% tax rate will apply to the first $200,000 of taxable income for foreign residents.
Lovely. And if I wanted to sell my property, how am I taxed when I do sell it?
So properties that are held for long-term investment are covered by the capital gains tax provisions. So generally the difference between your selling price and what we call the cost base of the property will be your capital gain or loss. So your cost base includes the cost of the land or the building, the apartment, stamp duty, and then buying and selling costs such as legal fees, selling agents' commissions and the like, things like advertising for the sale of the property. Your gain is then added to your taxable income for a year, so added to all of your other income from other sources like salary and wages, investment income, and it's taxed at the applicable tax rate, so what we discussed earlier before. A 50% discount can be available for capital gains, but this has been removed for foreign residents since 2012. Importantly, a capital loss doesn't give the investor a deduction in that year. It's used to offset any capital gains that are made in that year or any future years. So it will just carry forward until, say, you sell another property and make a capital gain. You can use that prior year loss to reduce that capital gain amount that's taxed. The other one to note is that there are CGT or capital gains tax withholding rules that apply to require a purchaser to withhold an amount, which is 12.5% of the purchase price, for properties that are valued at more than $750,000 when if the vendor is a non-resident. So it's not a final tax. The amount withheld can actually be claimed as a credit from the tax office when you lodge your eventual tax return. Australian residents who live in the property for a period may also be able to claim a main residence exemption for all or part of that gain.
Lovely. And does GST apply to investment property?
So the 10% goods and services tax doesn't apply to the rental of residential properties or the sale of existing residential properties. However, for new residential properties that are purchased from a developer, a 10% GST will be added to the price.
Lovely. And what are the other property taxes that may apply?
Yeah. So stamp duty and land tax are the big ones. They apply at a state level, though each state does have their own rules. So in Victoria, where I am at the moment, stamp duty is paid by the purchaser at up to 5.5% of the purchase price. Lower rates do apply up to purchase prices of $960,000. For foreign purchases, an additional duty of 8% can apply. So it makes the total stamp duty payable about 13.5% of the purchase price. And as I mentioned earlier, cost of stamp duty is not immediately deductible, but is taken into account when you're calculating your capital gain or loss when you sell the property. Concessions for off-the-plan purchases in Victoria are now limited to first-home buyers who live in the property, so you wouldn't be able to access that anymore. In respect of land tax, in Victoria, land tax applies to the total value of all of your land holdings at the end of the calendar year. So that'll be the 31st of December rather than the end of financial year, just to make it a little bit difficult. And there are 6 different tax rates that apply. That goes from no land tax if you've got total land holdings less than 250,000, all the way up to an upper limit of 2.25% if your land holdings exceed 3 million. And for foreign investors, an additional absentee owner surcharge of 2% might apply. Another thing to know is that land tax can be deducted on the tax return each year.
Lovely. And can I invest through other entities?
Yeah, so investment vehicles such as companies or trusts are commonly used to hold properties. They each have their own benefits and disadvantages. An Australian company will pay a flat tax of 30% on its income unless it's receiving mostly business income on which it gets lower tax rates. But if you have a rental property, it'll generally be 30%. And your distributions of any taxed profits from that company to foreign shareholders are generally tax-free because the tax has already been paid. However, Australian companies require at least one director to be an Australian resident. On the other hand, a trust is generally required to distribute its income annually, or it's taxed at the top marginal tax rate, which is 47%, so a fair bit higher. The beneficiaries that receive the income from the trust each year are generally taxed on the distributions that they receive, so the amount they receive from the trust each year at their own individual income tax rates. For non-resident beneficiaries, the trust will typically pay tax on their behalf at those non-resident tax rates. And the non-resident can then lodge a tax return and claim a credit if they've got other costs that they'd like to deduct against that income. Some trusts do have the benefit of flexibility as they can distribute to different beneficiaries each year. So you can distribute to one beneficiary in 1 year and a different beneficiary in another, depending on how you want that income to flow. And they also do have the benefit of the 50% CGT discount that we mentioned earlier, if there are Australian resident beneficiaries that can take advantage of that. However, it's important to note things like higher land tax rates that can apply to trusts with different grouping rules that also apply. So, for example, if you've got an investor that's got 5 properties worth $1 million each, land tax can be saved if you've got 5 separate trusts that each hold the property rather than an individual that holds all of them. But it's, as I said before, there are many complex rules that apply when trusts and companies are used. And it's also worth noting that there are greater costs of administration and compliance of using these entities. So things like additional tax return and annual fees that need to be paid to the corporate regulator.
Sure. And what other rules would apply for foreign investors?
I think that must be our last slide. In response to COVID-19, the federal government did announce that from the 29th of March 2020, all foreign investments into Australia must be approved by the Foreign Investment Review Board, no matter the size of the investment. Application fees can apply, and the process generally takes up to 30 days. That can be longer. In addition, both state and federal measures can apply where a residential property is vacant or unoccupied for more than half of the year. So at the state level, this can be 1% of the value of the property if it's located in the main metropolitan Melbourne area. At the federal level, it's known as a vacancy fee, and this can be over $5,500. The last thing to note on that is even if the property was fully occupied for the entire year, a foreign investor must also register and lodge an annual return with the Australian Taxation Office.
Lovely. And how has COVID-19 impacted property investors?
Yeah, so COVID-19 has really affected everyone everywhere, particularly for property investors. Investors who provide some rent relief to tenants that are affected by COVID-19 should be able to maintain their existing deductions if this is done to help them stay in the property and maximise your returns. So things like if you have had to either waive or defer some of the rent that you're receiving, or you've provided rental reductions for a period. Any rent that is deferred could result in that rent also being taxed in a later year. So instead of collecting it now, you collect it next year. You then pay tax on that next year, which can also then defer when you need to actually pay the tax on that by a significant amount of time. Investors who provide rent relief to their tenants between March and September 2020 are also able to seek a relief of land tax in Victoria of up to 25% of their annual liability, and that's in recognition of providing that benefit to tenants. Additionally, banks have also been offering relief for making repayments of interest as a result of COVID-19, and any deferred interest should still be deductible even if the bank has actually deferred the payment. So you can, in some instances, claim that interest cost now against your rental income, even if you're not required to pay that for another couple of months to the bank.
All right, lovely. Thank you so much, Chanel. We really appreciate you joining us and providing all that really relevant and detailed information. I'm sure the owners will find it beneficial. So
Thanks for having me.
appreciate it. Just for clients that may have further questions, feel free to email clientrelations@samma.com. I'm Samantha Parker, Department Head for Property Management at Samma Group, and we look forward to seeing you next time. Thank you.
Thank you.